Have you ever wondered about all the data that goes in your underwriting? Well, in today's video, Erin and I are going to chat about exactly what kind of reports and data points we use to underwrite your CMHC deals. Hey guys, Josh and Erin from Build Financial, back for another Finance Friday, and in today's video, we're going to chat about the different reports and data that CMHC use to analyze your file. Well, let's get right into it. There's a handful of different data points that CMHC uses. Some of them they get from us, some of them they get from third parties, some of them they use themselves, and somewhere in the middle they take all that information and they pop out a COI. Today we're here to talk about what those reports are, how they affect your deal, and how you can maybe mitigate any sort of backlash of having maybe a report or a number that is a little bit out of the scope of what CMHC might actually use. Let's get right into it.
Yeah, we're going to talk about some mortgage terms in this, and if you haven't already checked out one of our previous videos, we do underline a whole bunch of different terms and abbreviations and what they mean. So if this sounds confusing, either stop and go back and watch that or check that one out. First thing that we're going to take a look at is going to be getting an appraisal. Basically, anyone in real estate should know what appraisal is. Obviously, an appraisal is going to be done by a third-party person, and it is going to outline how they're going to appraise the building. Now, when we're taking a look at from a commercial perspective, that appraisal is going to be done on a net operating income, an income approach. And it's going to take a look at your NOI, your net operating income, and it's going to apply a market capitalization rate, a cap rate to that. And that's what's going to give us our value. Now, there's also going to be a few other things that we're going to have to take a look at in this appraisal. One of them is going to be the market rents. When we're taking a look at CMHC deals specifically, CMHC is quite sensitive to market rents and where your leases are compared to that market rent data. If we're taking a look at something where market rent is $2,200 and you're at $2,500 or $2,600, well, you're kind of taking a little bit of additional value there towards your building, and CMHC doesn't like that. So if you're way above that market rent and your building is coming in at a higher value, you might find that CMHC says, no, we don't agree with the leases that you have in there. You can keep them and you can collect that rent, but in terms of a value-wise, we're going to bring your leases back down into market normal and value the building from our own standpoint based off these market rents. And it does happen with CMHC. They have been known in the past quite often to be able to do their own underwriting and reduce the value of a building as they see fit.
Yeah, what's really interesting is actually anything above 25 units, we don't even need to get an appraisal done. So CMHC actually does an internal appraisal for anything above that 25 units. So it's really for any property or pre-existing building or new constructed building under 25 units where we go get an AACI approved appraiser to go and get the valuation. When we see the value being dropped due to exceptionally high rents, it's partly a mitigating factor because we can go get any appraiser to go do the actual valuation. So this happens more often than not. Just keep in mind, if you do get a really great appraisal that comes in, just keep in mind this actually might happen, and CMHC underwriter might drop the value down based off of market rents in the area, as Erin said. One thing to keep in mind is there's two different kind of types of appraisals you would get. You'd get an as-is appraisal and then possibly an as-complete appraisal if you are going through construction financing. Your net operating income once you have a stabilized building versus projected net operating income as well are going to be different. So this is where the mediator of the underwriter comes in to be able to determine whether or not it's in line with their guidelines. Most of the time everything's okay, but if you're on the aggressive side, you will have a little bit bumped down in value and net operating income there. Secondly, we get into vacancy rates. Vacancy rates are really important from an appraisal side. Your appraiser will give a vacancy rate to find your EGI or your effective gross income. This vacancy rate might not be reflective of the actual vacancy rate that CMHC uses. So CMHC has broken down different areas across the entire country and to little quadrants or little areas within a city. So if you go to a blanket, let's say 3% vacancy over southwestern Ontario, well, that's not necessarily accurate if you can really get granular on certain geographical areas or locations within cities, and that's exactly what CMHC does. So they have a map that we use to be able to determine exactly what the vacancy rate is, and sometimes that vacancy can range wildly between between 3 to like 12%. And if you have massive vacancy variances in your underwriting, this will drastically affect your approved amount that you qualify for.
Yeah, and also just understanding, again, that just because you don't have any vacancy in your building doesn't mean that the vacancy is zero. So that is an important thing. If you get some sort of data sheet from a seller or a realtor and you see a zero vacancy on there, just understand that that number is not going to be zero moving forward, and that is going to impact the potential financing on your building.
Best practices to really take a look at is like multi-year vacancy rates. I like taking a look at certain geographical locations within a city my client is buying in, and then looking at 2022, 2023, maybe 2024 data if it's out, to show maybe like a multi-year history of what this vacancy looks like. So for example, in Edmonton or in Calgary, you had high vacancy rates 3-4 years ago, but as population continues to grow, these vacancy rates continue to shrink, but it might be not as reflective as people would think because they're in a boom market right now. So being able to look at the multi-year vacancy rates and understand, well, what is the historical data showing me about this place? That's going to be a great thing for you as an investor, but it's also going to allow us to be able to determine an accurate vacancy rate when looking to underwrite your file, because you might have something different, but we're most definitely going to be able to check to confirm. So if you guys are looking for the actual vacancy rate, we can find that for you.
Yeah, and if you're in the development space, understanding what market you're building in, like a New Brunswick or in Alberta, where the ability for you to get in and develop these new builds is quite easy compared to Ontario. And if you're concerned at all about potential long-term overbuilding, going back and checking these vacancy rates and just giving yourself more of like a potential normalized vacancy rate. Where could it be in 10 years down the road? Like, what could my numbers be as we start to get these new units? So it just gives you an idea as to, again, understanding that over the last few years with real estate, especially new units being at such a low level, eventually as we start to get these numbers back, however long that's going to take us, that vacancy rate is going to change a little bit. So again, if you're developing long term, maybe take a look back, before 2020, just get an idea, what was the vacancy like in this area? And, if we somehow do manage to get these new units back up, and these vacancy rates increase, is that going to impact your project at all? And just have a better understanding.
Yeah, I'm a big fan of increasing the vacancy on my numbers anyways, to be a little bit more conservative on our underwriting approach. That being said, guys, median renter income. Most people didn't really look at this stat until the MLI Select program came out, but this is a very important stat for anybody who's looking to use this specific metric or get their points through affordability. Now, the median renter income, unfortunately, we are still going off 2019 data from CMHC. There are some indications that CMHC is going to be changing this data, and they are working on updating this data later on this year. September, October is kind of the area or timeline in which we've been told this is going to change, hopefully for the better. But the median renter income, what this does is it shows us the median renter income for every single large major city in the country. So this allows us to go to Abbotsford or to Oshawa, and we can figure out what the median renter income is and then determine from there how much an affordable unit is in that area. And as an investor who's looking to use the CMHC product, this allows you to be able to determine whether or not you want to have an affordable unit or what you need to rent a unit out for to be classified as affordable. Now, moving forward, the changes that are going to come out, we're expecting to have a much higher median renter income just due to obviously inflationary measures within the economy over the last 5 years. So what this means for people who are looking to submit with affordable units, it might make sense to wait until this new data comes out to submit your file, because we're anticipating that you're going to have a much higher affordable unit that you're able to rent out for. So the way it works right now is if you commit to affordable unit right now and you submit and you get your COI, which is your certificate of insurance, you're required to rent that out at the current affordable guideline as of today. And then every single year, you're able to increase that rent by annual CPI growth. And you're able to do that every single year. But what's going to happen is if you commit now and then the median renter income is here, you're going to have that massive gap where you could have had a much higher affordable unit. So what we're seeing is some investors, developers are waiting to see what that data looks like to see how this is going to affect the market. And this data we check all the time, but it's really nice that it's going to be updated.
Yeah, guys. I mean, especially with CMHC changing some of the requirements on the energy efficiency and essentially slashing that in half. The only way that you're going to get 100 points now is by moving into the affordable sector. Now, on the new builds, it's a lot more attractive to be able to take the accessibility because the requirements are drastically lower than what it's going to take on a pre-existing type building. But again, you know, like understanding where these rents are going to be at and what that looks like for you and your net operating income and you know, the value of the building, but also your affordability on it. It's really important to understand like what numbers we're looking at. And for myself, I've had conversations with investors, and you know, the conversation around affordable rents is about market rents and what that looked like. And unfortunately, it's not the case. I wish it was market rent, but it's not. It is based off the median renter income, and with it being based on the older data, it really is pretty debilitating in a lot of major cities. You know, there's not very many cities where you can have an affordable rent criteria based on CMHC and still actually be in positive cash flow. I think there's maybe like 5, maybe 6 cities across Canada where the numbers really make a whole lot of sense. So, you know, if you are taking a look at that, you know, again, just make sure you confirm with us that, you know, this is the number that I'm using and this is what I have to use. And also ensuring that you understand the amount or the percentage of your units that does have to be affordable. And again, CMHC rounds up. So, you know, 2.8 units becomes 3 units. So just understanding how they look at it and what those numbers are, very important until we get further clarification come October. For everything that we hear, it should be more positive come October. Again, just given the cuts that they made to the energy efficiency, I think they're trying to make that a little bit easier for people to get onto the affordable section, which is definitely needed.
Stay on your toes, though. You never know. It's going to change. But we'll be here to let you know how that changes. Last but not least, QS. If you are building something, CMHC or a lot of the lenders who will take on CMHC insured construction debt on a large scale will require a QS. This is a third party that will verify the actual cost of your construction. They will verify all the costs and expenses and ensure that your actual project is completed within the time frame expected, as well as the cost outlined. For smaller projects, we have seen some variances where, you know, somebody did construction and then they move into CMHC, their accountant is required to sign off on the actual construction budget, but a lot of the time CMHC is going to review your overall cost to ensure you're in line with the general cost of building an asset of that size.
Second, last but not least, is actually going to be your environmental report. Something that's actually not as known is that the environmental report's only actually needed on 7 units and above. So if you have a 5 or 6 unit building, you don't actually need an environmental report on your building, which could be beneficial given, you know, the circumstance. This doesn't have to be done before submission, like an appraisal. It just has to be done before closing with the lender. So we do have some time to be able to get that done if we need to. But again, you do need to have an environmental on your building for anything that is 7 units and above.
And just keep in mind, all of these reports are required to be less than 12 months old when submitting a CMHC. If you do have an old environmental report, an old appraisal report, an old building condition report if required, they need to be all up to date within 12 months. So that could be a little bit costly if you have an older project, but just keep that in mind if you are getting ready to submit. And again, we'll go through all of these things with you as you submit your files, so no need to worry. We really appreciate you guys taking the time to watch a video today. There are tons of changes to the landscape right now moving forward with CMHC construction development, and we are here to let you guys know exactly what's happening as it's happening. If you did like this video, please feel free to hit the subscribe button, hit the like button. It allows Ehren and I to do this for you every single week. If you have any video ideas or anything you want to understand and learn, we'd love to hear from you. Feel free to reach out. Our contact information is going to be down below. Really appreciate you guys. See you next time.